Hello. In this talk, I'm going to be discussing leverage, and we'll talk about how it impacts risk, or how risk is related to leverage, and we'll be talking specifically about operating leverage, financial leverage, and combined leverage. Operating leverage is impacted by the amount of fixed operating costs that you have. So for example, if you run a company or run a department and you have a lot of fixed cost, then you're going to be said to have a high degree of operating leverage. What are some examples of fixed cost? Fixed costs would be salaried employees, for example. Hourly employees are variable cost. And the difference being that an hourly employee obviously just gets paid for however many hours he or she works, whereas with the salaried employee, it doesn't matter whether the company is producing 0 units or 1,000 units, you still have to pay that employee their salary. So that's a fixed cost. Rent is another good example of a fixed cost. So the more of these types of fixed costs that your company has to incur, the more business risk the firm is exposed to. And I'll talk about business risk in more detail here in just a little bit. So we're going to take a look at operating leverage in a little bit more detail. We'll also then be introducing the idea of financial leverage and the financial risk that's involved with that. And the component that impacts the financial leverage is the amount of fixed financial cost that the firm has to be able to pay. And so the more fixed financial cost, and fixed financial cost, as we know, comes from bond financing, because you have to pay those interest payments or you're forced into bankruptcy. Preferred stock financing, even though you can't be forced into bankruptcy for missing a preferred stock dividend, your common stockholders don't get to receive any dividends until all preferred stock dividends have been paid up. So in that sense, it is a fixed financial charge. So the more of those types of financing that you have, the more financial leverage the firm has, and so therefore the more financial risk the firm has. So we start out with a revised income statement. I want to introduce this to you because everything now is going to be broken up between variable cost and fixed cost, because it is the amount of fixed cost that we're concerned about here. So this would be an internal document. This isn't something you're going to find on the annual report of a company. This would be an internal document that would be available within the company. They have things broken out into variable and fixed cost, especially if it's a larger firm, so that they can kind of keep tabs on these things. So the way this revised income statement looks is we have sales minus our operating variable cost. Okay, so again, our operating variable cost might be our hourly wage earners. Utilities can be a variable cost, right? Obviously, the more machinery you have working, assuming you're a manufacturing firm, the more the more you're going to have to pay in terms of utilities. If you're a service-oriented firm, variable costs might be office supplies, things that would vary with the level of production. Operating fixed cost, this will not change, right? This would include, as I mentioned before, maybe any salaried employees that you have, rent, things like that. And I kept the numbers small just to demonstrate the idea. And I have off here to the side operating leverage, because it's the amount of fixed operating cost that impacts the firm's operating leverage. So when we subtract the variable cost and the fixed cost from sales, we have earnings before interest and taxes. And then we would subtract our interest expense. And interest expense is fixed. Okay, it's a fixed amount, and it impacts our financial leverage, which is why I have that out to the side. So we subtract that, and then we get our earnings before taxes. And if we assume that our tax rate is 40%, we just multiply this by 40% to get our taxes, which in this case is $12,000, which by the way is a variable expense, right? The more earnings before taxes you have, the more taxes you'll pay. So you can think of it in a sense as a variable expense. And that leaves you earnings after taxes of $18,000. And then if there is preferred stock, you would have to take out your preferred stock dividends. And here we have total preferred stock dividends of $12,000. And again, to the side, note that I have financial leverage there to indicate that this does impact then the degree of financial leverage that the firm has. And that leaves us with earnings available to common stockholders. Stated another way would be net profit or net income, okay, but basically your bottom line. So just to kind of reiterate, operating leverage is impacted by your fixed operating costs. So if a firm has a lot of fixed operating costs, then they will be said to have a high degree of operating leverage. So specifically what that means is that for a small percent in sales, small percent change in sales, you will have a disproportionate change in EBIT. So one careful thing to note is operating leverage measures the relationship between sales and EBIT, earnings before interest and taxes. So if you have a disproportionate change in EBIT because of a change in sales, then operating leverage exists. And the more disproportionate that change is, the higher your degree of operating leverage. But we can actually measure that, and so we'll be looking at some equations that will allow us to do that. So let's say, and this is the base level income that would have to be given to you, but let's say that you have a base level of sales of 1,000 units. And if we assume, I don't have the I didn't put the price here, but if we assume that each unit is $10, then we have base level of sales of $10,000. And if we assume that the variable cost is $5 per unit, and again all those numbers would have to be given to you, if we assume that variable cost is $5 per unit, then our total variable cost would be $5,000. We're told that our fixed costs are $2,500. So our earnings before interest and taxes come to a total of $2,500. We can stop there. This is just the top portion of that adjusted income statement. We can stop there to determine our degree of operating leverage. So let's just say, for example, that we experienced a 50% increase in sales. If we experience a 50% increase in sales, then our sales in units are going to go up by 50%. So rather than 1,000 units, we're going to sell 1,500 units. Our sales in dollars will also increase by 50%. And so now rather than $10,000 in sales, we will now have $15,000 in sales. And our variable costs will also go up by 50%. So rather than having $5,000 in variable cost, we now have $7,500. Fixed cost, however, will remain exactly the same because it is fixed. So it doesn't change due to an increase in volume. And so when you go through and subtract, we find out that our earnings before interest and taxes is $5,000. So note that a 50% increase in sales caused a 100% increase in our EBIT. Okay, since that's a disproportionate change, we know that operating leverage exists. Now, this makes us happy. Operating leverage is a wonderful thing to have when sales are expected to increase because, for a 50% increase in sales, we're going to double it in terms of earnings before interest and taxes. So that's a great thing when you're on the upswing. However, if you're on the downswing, it's not so great. So for example, if we have, let's just take it exactly the other way and start with our base level. So we have 1,000 sales in units. We're going to cut that by 50%, which means our sales in dollars will be cut by 50%, our variable costs will be cut by 50%, and I'm going again off this base level of sales. My fixed cost remains fixed at $2,500, so my EBIT is 0. So what's happened here now is, because of a 50% decline in sales, I've had a 100% decline in my EBIT. So point being that operating leverage works exactly the same in both directions, whether you have an increase in sales or a decrease in sales. So obviously, if you're on the decline or you expect sales are going to decrease in the future, if it's at all possible, you want to shift as much of your fixed cost into variable cost as you possibly can. On the other hand, if you feel like in the future your sales are going to be increasing dramatically, you can try to shift some of your variable cost into fixed cost if that's possible, and then that would help what we call leverage your earnings, help boost your earnings. Now, we want to find out exactly what is the degree of operating leverage, and we can compute that using these numbers here. So just before I do that, though, let me just, this is a slide that just summarizes what I said so far, that it works the same in both directions, and if you have a disproportionate change, then we know that operating leverage exists. Okay, so how do we find the actual degree of operating leverage? Well, it's the percentage change in EBIT divided by the percentage change in sales. And if the DOL comes out to be greater than 1, meaning you have a disproportionate change, then we say that operating leverage exists. So using the example from the previous slide, we had a percentage change in EBIT of 100% that was caused by a 50% change in sales. So our degree of operating leverage is equal to 2. So another way we can interpret this is that for every 1% change in sales, we're going to have a 2% change in EBIT. A quicker, more direct formula for degree of operating leverage. This way you don't have to go through the whole little top half computations of the income statement. If you want to use a more direct formula to calculate the exact same degree of operating leverage, what you can do is use this formula here, where you take total sales minus total variable cost and divide that by EBIT. And remember, EBIT is sales minus variable cost minus your fixed cost. So using the same example that we used earlier, if we assume that we're selling 1,000 units, quantity sold is 1,000, and we assume the price per unit is $10, and the variable cost is $5 per unit, and the fixed cost is $2,500, then we had total sales, this was in our base case, right? Total sales of $10,000 minus our variable cost of $5,000 divided by our EBIT, which is sales minus variable cost minus fixed cost. And then sure enough, when you do the math, you end up again with a degree of operating leverage equal to 2. So either way you do it, you'll come out with exactly the same answer. Now, an important thing to note is that the degree of operating leverage is going to be much more sensitive to a change in fixed cost than it will be to a change in variable cost. And so I want to go ahead and demonstrate that to you. If you remember in the previous example, we had total variable cost in our base case of $5,000 and total fixed cost of $2,500, right? So our total cost were $7,500. Okay, let's leave our total cost at $7,500 and work another example, but let's shift some of that cost and see what happens. So what I'm doing here in this example is I'm saying, okay, rather than having our variable cost at $5 per unit, let's change it, let's decrease it to $4.50 per unit. So our variable cost is going to go down, but we're shifting that variable cost into our fixed cost. So the $500 that we're saving in our variable cost is going to shift to our fixed cost, and our fixed cost now is going to go from $2,500 to $3,000. So notice that our total cost is still the same, $7,500, just like it was in our previous example, except in our previous example this was $5,000 and this was $2,500. So we just shifted. We were able somehow to shift some of our costs. We can talk about ways in which we can do that. Okay, so following our DOL formula, we have total sales minus total variable cost divided by EBIT. And notice that even though our total operating costs are the same, the DOL went up to 2.2. Okay, from 2.0 to 2.2. And that's because our fixed cost increased. So now for every 1% change in sales, we would expect a 2.2% change in EBIT. So, and again, I just like to kind of summarize things in slides, and there I was just talking about how it's more sensitive to an increase in fixed cost, and so you see the DOL increasing from 2 to 2.2. So what does a degree of operating leverage of 2 or 2.2 mean to us? And again, this is that interpretation. If you have a DOL of 2, then what that's telling us is, again, a 50% change in sales is going to cause twice that in EBIT. So we'll have a 100% change in EBIT. And it depends, if this is an increase, then this will also be an increase. If this is a decrease, if our change in sales is a decrease, then our EBIT will also be a decrease. If our DOL is 2.2, then we're going to have an even larger change. A 50% change in sales will cause a 110% change in EBIT. So that's the way we interpret the degree of operating leverage. So you could see then, if a firm has a lot of fixed operating cost, and if their sales happen to fluctuate quite a bit, then they're going to get very wide fluctuations in their earnings before interest and taxes. And we refer to that as business risk. It increases the business risk of the firm. Now we'll take the income statement from EBIT down to income for common shareholders, and actually we'll take it one step further down to earnings per share. I'll talk about that in just a moment. And that's where we measure our degree of financial leverage. And so as stated earlier, financial leverage results from the fixed financial charges a firm has, which is either interest expense, and if they have preferred stock outstanding, then we have to consider preferred stock dividends as well. And so we'll see how that impacts the bottom line of that income statement. Okay, so now we have another example. We've got Ice Cream Cottage, a small business that's open 3 months per year, expects earnings before interest and taxes of $10,000 in the current year. It has $20,000 worth of bonds outstanding that has a 10% interest rate. And so we can compute the interest rate, right? The interest is going to be, at 10%, interest is going to be $2,000 a year, given you've got $20,000 worth of bonds outstanding. And they also have 600 shares of preferred stock outstanding, and that preferred stock pays $4 a year, assuming annual dividends, $4 a year in dividends. So then total dividends paid are going to be $2,400 per year. And it currently has 1,000 shares of common stock outstanding. So what is the degree of financial leverage? So now what we need to do is create the bottom portion of the income statement, because the degree of operating leverage, and this again is important to note, measures the relationship between EBIT and earnings available to common shareholders. Or you can take it one step further and say that it measures the relationship between EBIT and earnings per share. So here's the base level information in income statement format. So we said that earnings before interest and taxes were going to be $10,000. We subtract our interest expense, which we said was going to be $2,000. We had 10% rate and $20,000 worth of bonds outstanding, so $2,000. We have earnings before taxes then when you subtract of $8,000. We take 40% of that $8,000 to get our taxes of $3,200. Leaves us earnings after taxes of $4,800. Then we subtract our preferred stock dividends of $2,400, right? Because there were 600 shares at $4 per share, so we got preferred stock dividends of $2,400. Leaves us earnings available to common stockholders of $2,400. Okay. So now let's see what happens when there's a change. Let's assume that there's an increase in EBIT. So if we have an increase in EBIT, then let's say there's a 40% increase, then EBIT would go up to $14,000. Interest is fixed, so it would stay at $2,000. So earnings before taxes would be $12,000. Taxes, we'd have to take 40% of the $12,000. Taxes would be $4,800, and that would leave us with earnings after taxes of $7,200. Then we subtract our preferred stock dividends, which are also a fixed expense, and we're left with earnings available to common shareholders of $4,800. So notice that a 40% increase in EBIT caused a much larger increase in earnings available to common shareholders. And I'm not going to compute the percentage yet. I'm going to show that to you on the next slide, because I'm going to go ahead, as I said, there's the option of carrying it a step forward and looking at the change in earnings per share, which would be to take this earnings available to common shareholders and divide that by the number of common shares you have outstanding. And if you remember in the problem, it says we have 1,000 shares outstanding. So if we take 2,400 and divide by 1,000 shares, we have earnings per share of $2,400. I'm sorry, we have earnings per share of $2.40. Here we would have earnings per share of $4.80. It doesn't have room on the slide to put it here, so I'll show that to you in the next slide. But I just want to show you, before we head to the next slide, how a decrease in earnings per share causes the exact same type of change, right? So if a decrease in EBIT causes the same exact change. So if EBIT goes down by 40%, then it'll go from $10,000 to $6,000. Interest is fixed. Taxes would be 40% of the $4,000. Preferred stock dividends are fixed. So we have earnings available to common shareholders of 0. Okay, so let's compute the percentage changes for down here, but let's first convert this to earnings per share. Obviously, earnings per share here is going to be 0. So we'll see that on the next slide. Here's our earnings per share. So we had earnings available to common shareholders of $2,400 in the base case. And if we have 1,000 shares outstanding, that means each share of stock earned $2.40. That's the way we interpret that. Then when we had the 40% increase in EBIT, we saw that earnings available to common shareholders was $4,800. And if we divide that by the number of shares outstanding, we see that each share of stock earned $4.80. And then when we had the 40% decrease in EBIT, notice earnings per share drops to 0. So how do we compute exactly the degree of financial leverage? Well, to find the degree of financial leverage, we take the percentage change in earnings per share, which notice it is a 100% change, right? Earnings per share doubled, just like our earnings available to common shareholders doubled. And then on the decline, we see that earnings per share completely disappeared. So a 40% change in EBIT caused a 100% change in earnings per share. So we have what's called a degree of financial leverage equal to 2.5. Now again, we have a more direct formula. If you don't want to go through the whole income statement calculations, we have a more direct formula that will give us exactly the same answer. And so that more direct formula for the degree of financial leverage is to take EBIT and divide that by EBIT again, minus your interest expense in dollars, minus your preferred dividend in dollars, but you divide the preferred dividends by 1 minus the tax rate. We make that adjustment because dividends are paid after taxes. And so we've got, in our base case, we had EBIT of $10,000, and we divide that by an EBIT of $10,000. Our interest expense was $2,000. Our preferred stock dividends were $2,400. And then our tax rate was 40%, so 1 minus the tax rate is 0.6. And when you run through the math, you get a degree of financial leverage of 2.5. So you would get the same answer either way. So what happens if we put those together? We get what's called the degree of combined leverage. So to demonstrate that, I'll use this problem here where we've got Cables Incorporated is a computer cable manufacturer, and they expect sales of 20,000 units at $5 per unit in the coming year. And they have to meet the following. Their variable costs are going to be $2 per unit. So let's note a couple things as we're reading through this problem. We've got 20,000 units at $5 per unit, so we're going to have total sales in our base case of $100,000, right? And our variable cost is $2 per unit, so our variable cost in the base case is going to be $40,000. Our fixed operating cost is going to be $10,000. Our interest expense is given at $20,000, and our preferred stock dividends are given at $12,000. The firm has a 40% tax rate, and it's said to have 5,000 shares of common stock outstanding. So we are asked to calculate the degree of combined leverage. First thing that's important to note is the degree of combined leverage takes into effect both the degree of operating leverage and the financial leverage, the degree of financial leverage. So it takes both of those into effect. Which is why it gets the name degree of combined leverage. Sometimes it's called the degree of total leverage. So we are encompassing both our financial risk and our business risk when we're looking at the degree of combined leverage. So more specifically, the degree of combined leverage is looking at the relationship between sales and earnings per share. Okay, so the very top item in our income statement and the very bottom item in our income statement. So let's take a look. Let's put this base information in an income statement, in income statement form and see what happens. So here's my base information. As I said, we had sales of $100,000, variable cost of $40,000, which we have to subtract, fixed cost of $10,000, leaves us EBIT of $50,000. We're told in the problem that interest is $20,000. That leaves us earnings before taxes of $30,000. Then we subtract our taxes of 40% of $30,000, which is $12,000. Leaves us with earnings after taxes of $18,000. Now we subtract our $12,000 in preferred stock dividends, which was given to us in the problem, and that leaves us earnings available to common shareholders of $6,000. And on the next slide I've got the earnings per share, and I'll show you that in just a moment. So this time I didn't take it up and down. I think you get the point that it works the same in both directions. So what if there's a 50% increase in sales? What happens to earnings available to common shareholders and earnings per share? Well, our sales would go from 100 to 150,000, be a 50% increase. Likewise, our variable cost would go up by 50%. Our fixed cost, this is fixed operating cost, would remain fixed at 10,000. Leaves us EBIT of $80,000. Then we subtract our fixed interest expense at 20,000. Leaves us earnings before taxes of 60,000, and we multiply that by 40% to get our tax liability of 24,000. Leaves us earnings after taxes of 36,000. Then we subtract our preferred stock dividends of $12,000, and then that leaves us with earnings available to common shareholders of 24,000. So notice that we have a very large increase in our earnings available to common shareholders, and we'll have that same very large increase when we convert that to earnings per share, which we do on the next slide. Also notice that since it encompasses the entire income statement, we can look here at the relationship between sales and EBIT, which is your degree of operating leverage, and we could look at the relationship between EBIT and earnings available to common shareholders, or earnings per share, and get our degree of financial leverage. So here's where I converted the earnings available to common shareholders and divided by the number of common stock outstanding, which was stated in the problem at 5,000. So when you divide, in our base case, we had each share of stock earning $1.20. Then, after the increase in sales, we saw that our earnings available to common shareholders went from $6,000 to $24,000. And we divide that by the 5,000 shares outstanding, and we have earnings per share of $4.80. So notice how the change in sales caused a very huge change. By the way, a 50% change in sales caused a 300% change in earnings per share. And so I'll show you that in just a moment. It's interesting to look, though, at the DOL, because if you go back to the previous slide, you'll see that a 50% change in sales caused a 60% change in EBIT. You can compute that by just going back and looking at the change in EBIT in our example. So notice it's just barely above 1. So we have a very low degree of operating leverage. So not a lot of fixed operating cost. Here's where all the leverage is at. It's with the degree of financial leverage. If you look at the percentage change in EBIT versus the percentage change in earnings per share, that gives you your degree of financial leverage, which is 5. So that is big. So how do we arrive at the degree of combined leverage or total leverage? Well, there's 3 ways we can find it. One is to take the percentage change in earnings per share, which we saw that a 50% change in sales caused a 300% change in earnings per share. So that's one way. The second is to use a more direct formula, which is shown here, where you would take your total sales minus your total variable cost, and all that's divided by EBIT, which in our income statement was $50,000, minus our interest expense, which was $20,000, minus our preferred dividends, and then we divide our preferred dividends by 1 minus the tax rate. And then that gives us a degree of combined leverage of 6 as well. Up here, I guess I'm missing my 6, but this obviously would equal 6, and then this would be 6 as well. There's actually a third way we can find the degree of combined leverage, and that is to multiply the degree of operating leverage and financial leverage. So we found on the previous slide that the degree of operating leverage in that example, in the Cables Incorporated example, is 1.2. The degree of financial leverage is 5.0, and so the degree of combined leverage would be 6. So you get the same answer all the way through. So just to summarize then before we end, the degree of operating leverage is an indicator of business risk, because again, the more fixed operating costs the firm has, the more volatility the firm is going to experience in their earnings before interest and taxes if they were to have changes, much in the way of changes in their sales. So if you've got a firm that has much volatility in its sales, then you probably want to try to minimize the amount of fixed operating cost that you have. The degree of financial leverage is said to be an indicator of financial risk, because the more fixed financial charges you have, then whenever there's a change in EBIT, it's going to cause a very large change in your bottom line. Okay, your earnings available to common shareholders or your earnings per share. So again, if you work with a firm that has a lot of variability in its sales or its costs, then you probably don't want to hold a lot of fixed financial charges, because a small change in EBIT could cause then a very large change in your bottom line. And then the degree of combined leverage combines both of those together. So it doesn't separate your degree of operating leverage from your degree of financial leverage. It's just looking all together. What is your exposure to business risk and financial risk due to both factors combined. Thank you for listening.